Hello. The company being analyzed today is Five Star Business Finance. As you can see, this is an NBFC, a non-banking financial company. So, yeah, today we analyze its financials, what kind of loans it gives out, what kind of loans have gone bad, and many other things. So, let's start with the analysis. And just a disclaimer, this company may be the most profitable lending institution I have personally ever seen. Like, this could really be the most profitable. But let's see that. First year market cap 15,788 crores. Okay. Current price of one share is 536 rupees. The book value, meaning the net assets, is 214 rupees per share. Return on equity is really high, 18.6%. Return on capital employed is an extremely high 16.3%. Like for common banks, for normal bank, this will be like 7 point something percent, 7.5%, 7.6%. Like for HDFC, ICICI Bank, you would see 7.8 or 7.9% as return on capital employed. For any NBFC, you can maybe will see this at 8%, 9%, but the return on capital employed of 16% is insane, and a price to earnings ratio of 14.5. So insanely profitable in terms of return on capital employed figures. Then, looking at the profit and loss, we got data from 2017 all the way to 2025, which we will see. We have revenue, we have financing profit. And look at this, look at these extremely high financing margin. We will look into it. So, sales were 86 crores in 2017. 2017, it's a very small company. Fast forward to 2021, explosive growth, it reached 1,050 crores worth of sales. Then fast forward to 2025, we see 2,848 crores worth of total revenue for the company. And you see this figure, 1,072 crores of profit after tax. So hold up, 2,848 crores of revenue, out of it, 1,072 crores is pure profit. So you can calculate the net profit margin and you can see the level of profitability that we are actually dealing with here. So extremely profitable. In terms of percentages, you can see the compounded sales growth has been 29% over the last 5 years, 31% over the last 3 years. TTM is trading 12 months, 25%. Compounded profit growth has been 33% over the last 5 years. You can see extremely solid sales figures, extremely fast growing company. And return on equity has remained pretty stable and 17, 19%, very respectable return on equity. Though the company currently is facing some stress in terms of bad loans, which we may discuss. So currently going through a bit of stress. Let's see how they can handle that. Now, more analysis. So these are some more numbers. The company has 500, sorry, 767 branches. My fault. 767 branches in total. Its total loan portfolio is 1,24,578 million rupees, which is 12,457 crore rupees. Gross NPAs. What are NPAs? Non-performing assets or loans that have gone bad. 2.46%. Interesting. The net interest margin, again, the net interest margin of 16.43 is insane because usually net interest margin for, let's say, established banks like Axis, ICICI, it will be 4 to 5%. For some NBFCs, it could be maybe 7, 8, and maybe 9%. 16.43% net interest margin is actually insane, and an insane return on assets of 7.24%. Again, established banks, you can see maybe 2% return on assets, 1 point something percent return on assets, maybe not even 1% return on assets for someone like DCB Bank. It has like 0.94% return on assets. 7.24% return on assets is insane. And return on equity, 16.57%, still respectable. Yes, let's move forward. So, a lot of information has been present here. um, we can see this 100% secured. Its loan book is 100% secured. So it's backed by collateral. And you see 95% secured against SORP. SORP is self-occupied residential property. The average ticket size, the average size of loans it gives out is 0.39 million rupees, which I believe is 3.9 lakhs. 3.9 lakhs or 0.39 million rupees is the average ticket size. The capital adequacy ratio of 49.15 is actually, it's like normally it's like 18%, 20% capital adequacy ratio. 49.16% capital adequacy ratio is extremely high. So on that side, it's pretty safe. Then the net, see the gross NPAs we saw 2.46, net NPAs 1.25. The credit cost is actually pretty high. 1.3% credit cost is actually pretty high credit cost. That's a negative. That's a negative from what I remember. Then double A minus is the rating. Okay, double A minus. What else? And we have seen all of these numbers. Average loan to value is 39.2. So the I think this collateral offered is 30 collateral offered. So loan amount offered is 39.2% to the collateral. I think so. Though I can be wrong. Let's move forward. This video is not going well, I have feeling. So number of branches. You can see there has been a rapid growth in number of branches from 2016 all the way to 2023. Okay, they've only given information in 2023, but you can see 63 branches, 64 branches in 2016. Rapid growth all the way to 373 branches as of 2023. Oh my God, even more growth after that. Oh yes, and then 748 branches in 2025. You can see massive, massive growth in branches. Massive, massive growth in branches. Then what else? The loan dispersals have also grown. As you can see, dispersals are the amount actually given out. So in 2016, 1,319 million rupees, 131 crores of loan dispersals were given out. Fast forward to 2025, 4,969 crores were the loan dispersals or loans actually given out for the year. So massive, massive growth even in loans and branches. Extremely fast growing company, it seems like. Then cost to income ratio. This is pretty impressive. I have to say. Many banks will see cost to income ratio like South Indian Bank and all. Will have cost to income ratio 50-60%. And lower cost to income, it's a sign of efficiency of a bank. So major banks will have this in like 30s, and five-star business has actually maintained this in the 30s. See, let's move forward all the way. Let me just see, 35.5. Impressively nice. Nice cost to income ratio. Gotta say that. Then CRAR, again, capital adequacy ratio of 39%, 52%. Great. What else I can show? Return on total assets, return on equity. You can pause. Now, provision coverage ratio. You can see provision coverage ratio of only how much is provision coverage ratio? 50% is really low. 50% of provision coverage ratio is actually really low, but maybe the CRAR makes up for it. Maybe yes, maybe no. Okay, let's move forward. Now, this again is insane. It's portfolio yield. This line, this darker blue one, it's a portfolio yield. So the interest rate on loans that gives out 24% interest rate on loans. Who is getting these loans? So, and you can see the cost of borrowing. The cost of borrowing, so the lighter line, is 9.64. So the difference in percentage points of cost of borrowings and the yield on advances or yield on the portfolio. You can see this is the difference. 14.39 percentage points difference is again pretty insane and is overall on the rise. So this year took a bit of a hit. Then AUM by geography. Where is the assets coming from? 28% in Tamil Nadu, 37% in, is it Andhra Pradesh or Arunachal Pradesh? I have a feeling it's Arunachal Pradesh. 37% in AP, assuming Arunachal Pradesh. So these two states, Tamil Nadu and AP, massive concentration. Then third, we have TS. I don't know which one is TS, but then we move. Then AUM by average ticket size. So average ticket size is 3.86 lakh rupees. Okay, 3.86 lakh rupees is the average ticket size. Okay, vintage of loans. The time of loans. So 37% of loans are actually, wait, 37% of loans are repaid within 1 year, and 50% of loans are repaid within 1 to 3 years. Ooh, so a lot of like pretty short term loans. And AUM by branch tier. So 45% is coming from, which tier is this? Tier 6. Hold up, branches in tier 6. Oh my god. So in the low tier cities, it's more concentrated in. Tier 6 is contributing 45%. Tier 5 branches in tier 5, I believe. I think it is cities. It's like 31%, and we can see the all the next. I could be wrong. Do tell me down below. Then what else to see? Hold up. Let me see my notes. What else to show? The gross NPAs. So gross stage 3 assets, these are the loans that are going bad. And the net stage 3 assets or the net NPAs, you can search these on Google. Both are important terms. Are on a bit of a rise. At least for the past 2 quarters have been on a bit of a rise. And this is something to monitor.